Hello YouTube, Salivate Metal here, and I found this article here from Forbes magazine about some news that broke a few days ago, and I remember when it broke, and I'm kind of surprised there wasn't more discussion about it here on YouTube, but sort of a prelogue before I get into this article here. Most of you remember I posted a video a while back, probably about 20 days ago or so, about sort of an event that's going to come on July the 5th, with massive velocity and trading of the physical metals amongst the powers that be within banks and the like that's coming up. And this could be a precursor to that. We shall see if it's true. I'm kind of skeptical, like most of you who had commented in that video, learning a little bit more about the motivations behind some. It's kind of easy to be skeptical about these kind of things, about where gold and silver prices could be, but this could be one aspect of it. Who knows? It may be a nothing burger, which seems to be the word of the year, it seems like. But this article was pretty good, talking about the Federal Reserve giving a green light for the banks in a stress test. About 34 of them were reviewed. So let's go through this thing. And this is an opinion article, but I thought it was pretty well written, and talks about how we may or may not like various parts of the Dodd-Frank, but this all seems entirely reasonable. The major U.S. banks have all passed the relevant stress test and thus are allowed to return capital to shareholders through dividends and stock buybacks. This is how the system was meant to work after all. There's no requirement that they then hold more capital than the regulations say they must. And without being too sarcastic about it, there's probably very good reason they shouldn't hold more capital than they are required to. These regulations, formed by the finest salons on the planet, will have been defined the correct amount, won't they? To think otherwise is to worry that perhaps a detailed regulation isn't the way to solve all problems. Amen to that. The news today is that most of the large banks have announced large capital disbursements. Shares of large U.S. banks jumped higher in the pre-market Thursday after the Federal Reserve cleared their capital return plans. Morgan Stanley, J.P. Morgan Chase, Wells Fargo, Citigroup, and Bank of America all traded at least 1% higher before the bell. The U.S. Central Bank did not object to any of the buybacks or dividend hikes from the 34 banks it reviewed during the second phase of its annual stress test. The results seem to be rather higher than that, actually. Morgan Stanley was up 2.7%, and then we go through the list of some other banks. So here's the real point. The Federal Reserve told big banks that they have more than enough capital, and they promptly announced a windfall for their shareholders. Think back to what the crash actually was. In its action, it was a wholesale run on the large banks. People who didn't have FDIC insurance, pretty much everyone with more than $250,000, wanted to get their money out of the banking system entirely by choice. But if not, then the banking institution they knew was safe. The problem is no one really knew who was safe, for the banks had all been operating with then capital cushions. As the losses on those CDOs and all that started to come through, those cushions were being eaten away at. That of Lehman vanished, for example. No one really knew who was safe anymore, and that's really what the problem was. So our problem is in two parts. One is the run, and one is a lack of capital causing the uncertainty. Who had enough capital to absorb the losses and who didn't? This part of Dodd-Frank, these stress tests, cannot tell us who would survive or run. For capital doesn't aid you in surviving one, and that's what the Federal Reserve and emergency lending powers are for. But obviously, a decent amount of capital cannot stop people from worrying about whether you're going to go bust by convincing them that you've enough capital to survive some losses. I'm deeply unsure about the details of these tests, unsure in the sense that I doubt they're quite right. But the basic concept is just fine. Any fractional reserve banking system is open to the sort of loss of confidence which produces a run, and that's just a feature, even if an unwanted one, of the system. The insistence by the regulatory authorities that there's enough capital to absorb likely potential losses with the aim of preventing the appearance of a run is just fine, therefore. So at least we've had a part of Dodd-Frank which accords with basic logic then. Last week, the Federal Reserve announced the results of a bank stress test. These look at the idea that a massive, unwanted, and unprecedented recession turns up in the U.S., as if the parents-in-law turn up unannounced on swingers night. The bank all passed this. The largest national bank holdings companies have strong capital levels and retain their ability to lend to households and businesses during a severe recession, according to the results of the supervisory stress related Thursday by the Federal Reserve Board. The most severe hypothetical scenario projects a $383 billion in loan losses at the 34 participating banks holding companies during the 9 quarters tested. The severely adverse scenario features a severe global recession with the U.S. unemployment rate rising by approximately 5.25 percentage points to 10%, accompanied by heightened stress in the corporate loan markets and commercial real estate. The firm's aggregate common equity Tier 1 capital ratio, which compares high-quality capital to risk-weighted assets, would fall from an actual 12.5% in the fourth quarter of 2016 to a minimum level of 9.2% in the hypothetical stress scenario. Since 2009, the 34 firms have added more than $750 billion in common equity capital. So at least as far as we're able to tell, the banking system would survive a deep recession. Excellent, at which point all those banks pointed out that, well, actually, they had more capital than they needed to pass these tests. So please, may we send some of it back to our stockholders? The answer from the Fed being, as it should be, sure. The Federal Reserve Board on Wednesday announced that it has completed its review of the capital planning practices of the nation's largest banks and did not object to the capital plans of all 34 banks, holdings, companies participating in the comprehensive capital analysis and review. However, the board is requiring one firm to address the weaknesses in its capital planning process and resubmit its capital plans by the end of 2017. So CCAR, in its 7th year, evaluates the capital planning processes and capital adequacy of the largest U.S. bank holding companies, including the firm's planned capital actions such as dividend payments and share buybacks. Strong capital levels act as a cushion to absorb losses and to help ensure that banking organizations have the ability to lend to households and businesses even in times of stress. Dodd-Frank rightfully insists that the Fed check that the banks have enough capital to pass the stress test. They do. They've got more than enough. So the Fed is allowing them to make those dividend payments and conduct those stock buybacks. This is the way the system is supposed to work. And, I kind of sort of disagree with some of this, and that I don't think there should be, I don't know. I'm at, there's sort of a push and pull here, playing devil's advocate. What does regulation really do? It's kind of held back some of this capital that could have been used before all of this to help, stimulate the economy and the like, and naturally. And so we're passing this arbitrary stress test, and not knowing, we've read part of what it does, and on the surface it sounds good. And this article, it sounds like that it's critical of the Dodd-Frank legislation, which I am as well. But this portion of it they say is good, and I don't even know if I would go that far, because what kind of hubris of a federal agency to be able to audit these banks when the federal government itself is running almost $20 trillion debt and spending in deficit spending every single year. Our fiscal house is not in order in the federal government. Most state governments are not in order. Illinois is in a Puerto Rican style crisis mode. And so I'm skeptical in some ways of this, but the overall tenet of the article is good in saying that this is how it should be, that capital should be out, it should be able to give to their stakeholders and share that out. So here's the overall analysis of this article here. is that now that it's passed this stress test, whether or not you agree with it, that's going to obviously give some confidence to the markets. And we talked a little bit about that in the first page of this article. So how that will that react to silver and gold? Will they suffer because of this? And my guess is they probably will, if not for a couple of days, probably, because, and it could be that money being freed up, knowing the stress test was happening, in the scenario that I mentioned for that article about the Andrew Maguire prediction. Could this mean that these bankers are using some of that capital in some way, in permission from their stakeholders, to buy physical gold and silver, massive amounts of it, the physical, which then will then drive the prices up because they want the prices to be down with this free money that's come through. Because obviously, when the dollar is strong, and of course we've seen the dollar index being low, but nonetheless, gold and silver prices are low, and this may be one reason as such. So they buy up massive amounts of it, causing the price to go up, and other factors as well too. Very interesting, very complex. There's a lot of different scenarios and a lot of different portions of this and aspects to all of this, but nonetheless, very interesting indeed. So post your thoughts below on what you think of this news and this information about the Fed and the stress test and how it will affect gold and silver. I'd like to extend a multitude of gratitude y'all for watching and encourage you to please rate, comment, and subscribe.